This program is a presentation of UCTV for educational and non-commercial use only.
It's my great pleasure to welcome the wonderful team at JPMorgan who've been great friends to our school and hired people and been very engaged in some of the classes and the internship program here. Our speaker tonight is Todd Maclin, who's CEO of commercial banking operation at JPMorgan Chase. And for those of you who have somehow been under a rock over the last year or year and a half, you've probably noticed that JPMorgan is one of the very, very few winners out of the turmoil, the crisis, the real anxious market environment in which we're in. JPMorgan Chase is today over a $2 trillion financial services operation in 60 countries in every segment of the financial services business: consumers, small business, investment banking, asset management, and private equity. Chase Commercial Banking, the division that Todd heads, is the third largest commercial banking franchise in the United States, with a presence in almost 30 states. Provides a full range of products and services to over 26,000 consumers, and in 2008 had record revenue of almost $5 billion. They've earned leadership ranks in many product areas, including deposit and treasury management, commercial cards, asset management, direct lending, capital markets, and investment banking. Todd has been here for a couple of weeks and is going to be here for another week because this is a whole new market for JPMorgan with the acquisition of Washington Mutual Bank. It's expanding its West Coast operations, and with this acquisition of Washington Mutual Bank, they've acquired 700 branches in California alone, and Chase Commercial Banking is now in the process of building a middle market operation, a middle market business on the West Coast. And what do they mean by middle market? Well, it's between $500 million and $2 billion for the target operation. Now, Todd's a 30-year veteran of JPMorgan Chase and the various banks that were somehow in there. As you know, there's this multiple rollout that's constantly occurring in the banking industry. Held a variety of leadership positions in the company's investment banking and commercial banking divisions. I don't think you'll have any difficulty spotting where his roots are. He's got that Texas twang. These roles have included regional executive for Texas and the Southeast United States and global executive for energy investment banking. He basically said they needed someone to run the energy division. They heard his accent and they put him there. It didn't have a whole lot to do with his knowledge of energy, but I'm sure there was more to the story. Todd's a member of the operating committee for JPMorgan Chase, the senior-most operating group of the firm. Also serves on the JPMorgan Chase Foundation, which is the charitable arm of the bank. He's an active member of the community in which he lives, serves on the executive committee of the Greater Dallas Chamber, advisory director of the Export-Import Bank, advisory member of the National Petroleum Council, must have learned something about energy by then, member of the YPO and the WPO, a national trustee for the Boys and Girls Clubs of America, and I am pleased to say that he's also a member of the University of Texas McCombs School, which is the UT Business School, where he serves with the dean, who's a good friend of ours there. Todd holds a bachelor's degree from UT Austin and an MBA from the University of Houston. In addition to Todd, we have a wonderful team here. I want to first introduce John Miller, who's the Vice Chairman for Entertainment Industry, has been a longtime friend, and we call him the Dean of Entertainment in Los Angeles. Really makes a lot of the financing in the entertainment industry happen. And the person that's really taken over from John in the entertainment division at JPMorgan is our own graduate, David Shaheen, who's a FEMBA graduate of 2000. With them is Sue Wegleitner, who's Managing Director of Mid-Corporate Banking, the Western region. And a person who isn't here tonight but was really key to making this evening happen is Jeff Loeb, who was a Managing Director in the marketing division of JPMorgan here in Los Angeles, and has since he's taken early retirement, but has since become a member of our career services team for the FEMBA program, and many of you have probably enjoyed speaking to him because he's helped with financial sector expertise. Todd is going to, well, before I introduce Todd, one more thank you is to the Investment Finance Association that helped us co-sponsor the event tonight, and also Sean Hintz, president of the IFA, who was instrumental with a variety of events, and we love to see student leadership around these events. Todd will be picking up on the video that we just saw, which is the changing landscape of financial services. He'll speak briefly, and I hope you'll prepare your questions because there'll be ample Q&A, and we'll stop in time for you to get to your 7 o'clock classes. So please welcome Todd Maclin.
Okay, I'm going to have to bring this up a little bit. I don't know why she suggested I'm from Texas. We're so understated, especially when we go to the University of Texas. So you can just say I'm almost as obnoxious as that school across town. You know, and I'm looking forward to when we get to play you guys because we're tired of beating them. Anyway, I may live to regret that one. So I really appreciate, Dean, the invitation to be here and to speak to students at UCLA. You know, one of the things that's great about my job is that when you get to sit in the position that I'm blessed with, you really get to see a lot of things that, in terms of the last couple of years. And as students, I mean, you should just remind yourself all the time that these events are of a scale that those of us that have been in business 30 years or more have never seen before. So I think pay close attention, and every now and then when I see that 2-minute video, it reminds me of just all the things that have happened in the last year and just how tumultuous it's been. And I think it says a lot for our system that we're all here sitting around talking about it, and that those markets have left that period of systematic risk. But you know, to be sure, the world economy and financial markets have had a very rough couple of years, and we've suffered through a really tough recession. And it's not, even though that recession is probably over, it's in a very soft recovery, and unemployment is continuing to rise. The economy is really, and the improvements to the economy aren't reaching a lot of Americans. You know, millions of people are either out of work or underemployed. The total unemployment in the U.S. exceeds the total unemployment for all the U.S. exceeds the total employment for all but just a few of the largest states in the United States. So that kind of gives you a perspective of just how tough it is out there. And so when I was reviewing these slides with my 22-year-old son who just got his undergraduate degree, he said, "Dad, it sounds like a great time to go to graduate business school." So I certainly agree with him on that one. So I want to speak to you about the road to recovery. I want to talk to you about where I think we might be on that journey. I want to focus on trends in banking and capital markets, since that's really the subject I know best. I want to try to give you a view of the next 6 months or so, and then I think I want to give you a little bit of information on our organization, since I know as students some of you may be interested in a career in banking. Much has changed in the past year in the financial services industry. We're no longer worried about systematic risk, but many banks and other market participants are still in a lot of trouble. And this will give you a visual of that. As we all know, the landscape has changed a lot just in the last year. And of the 24 logos that are on this page, it's now been reduced to 17. The bank failures are not over. They're on the rise. And commercial real estate is the latest threat on the horizon for commercial banks. We've also gotten into a period of the haves and the have-nots. Those depicted in green on this slide have passed the stress test, and all but one of the names has repaid TARP. All but one of the green names has repaid TARP. But at the same time, there are still a number of red names on the list with TARP money and not having repaid that or passed the stress test. Stock performance is also mixed. 11 banks have seen at least some degree of stock price appreciation since the first of the year, although there are still 7 banks on the list whose stock has declined further since the first of the year. And so the stock market is sort of telling us that systematic risk may be over, but there sure is a lot of stress in the system, and I'm not really sure how all the bank participants are doing right now. And as I said before, the FDIC has said that there are 416 banks on their problem list, and that's the highest number of problem banks in over 15 years. So I think we can say that whether we agree with what's happened so far in terms of saving banks, the opposite of too big to fail is too small to save, and so we should expect more failures to occur. Now, states like Florida, Georgia, and here in California and Illinois have been the hardest hit in terms of bank failures. And most of these failures were caused by the excesses of the residential cycle of the economy. The FDIC estimates, though, that it's going to cost in total $100 billion for bank failures through this recession, and that's a record. But Capital Land credit markets. And it's not that way on my slide, just for the record, okay? But capital credit markets are improving, and so that tells us that we're worried about market participants, but we don't have the same level of systematic risk. And I'll go through some slides to show you how we look at that. The first one is the equity market, and it's gotten back a lot of its gain, a lot of its loss. It's gained back a lot of that space that it lost last year and earlier this year in the rally that's occurred in the sort of the middle half of the year. And so the good news is that we're seeing that improvement, and that fares well for the economy. The next slide I'm going to show is a little more technical. So this is a pop quiz question. Does anybody know what the TED spread is? Don't everybody raise your hand at once. Does anybody know what LIBOR is? LIBOR is essentially a proxy for what banks borrow from each other short term. Does anybody know what T-bill is? T-bill is the rate that the government borrows, the U.S. government borrows short term. So the TED spread is the difference between 3-month LIBOR and 3-month treasuries. And the reason you have a TED spread is to try to measure how much over the T-bill price are banks willing to lend to each other short term. The TED spread peaked out in October of last year at 458 basis points. So somebody needed 4.58% short term to justify a spread they would lend to each other as banks. That, my friends, is systematic risk. That's when people are so afraid they're afraid of each other and they're afraid of themselves. If you fast forward, the TED spread is now running around 20 basis points, and that's a more normalized level. So the banks are back to doing business with each other and less concerned about making a short-term loan and then having it subsequently fail. At the same time, though, we're delevering banks, and there's definitely a continued credit crunch that's on. This chart attempts to show that what happens when banks delever. And I'm going to make it sort of simple, but if you look at the first chart on the left, the total bar represents the asset base of the world's 80 largest financial firms. And that accounts for about $49 trillion of assets. Let's just pretend, for discussion purposes, that those assets are all loans. It's really loans and investments, but for simplicity, we'll say they're all loans. And so if that little sliver of blue at the bottom is the bank's capital, which has historically been around 8%. That means that that banks really have leveraged their equity 12.5 times, such that every dollar of capital gives banks $12.50 for lending. But banks are changing those capital requirements as the markets have decided and as government has decided that that ratio needs to change. And the new standard is likely going to be 10%, maybe more. If it just goes from 8% to 10%, that serves to reduce the asset base that banks can leverage their equity by about $9 trillion or 20%. So when you hear and read in the paper that there is a credit crunch on, that banks aren't lending, just based on the standard of new equity requirements, that's true to the tune of $9 trillion. And if ratios were to go even higher, to say 12% capital, then that would go from $9 trillion of lost capacity to $16 trillion. And so at the same time that banks' capacity to lend is falling, you can also say that their desire to lend is falling in terms of, because we're in a tough economic environment, and so the risk of loss and the risk of default has increased. I'm going to use, if you guys talk about debt to cash flow in your classes or understand that concept. So if you look at debt to EBITDA or debt to cash flow as a proxy for risk, you can see that leverage parameters were as high as 4.9 times debt to cash flow in 2007, and those ratios have fallen to 3.7 times. So in other words, the average bank loan at the upper end that they're willing to do on a leverage basis is to a company that has 3.7 times versus 4.9 times debt to cash flow. Again, another example of how credit crunch and financing availability cuts back. And that's the lowest level we've seen in this ratio for 20 years. And then finally, when banks do lend, it's for a shortened tenor. The chart shows that beginning in 2004, the majority of investment grade revolvers were for a multi-year basis. And multi-year used to mean 5 years or longer. In 2008, that trend has dramatically shifted. And in the first quarter, only 12% of the loans were offered for longer than 364 days. As we've gone into the second quarter, it's improved, but the term loan has gone from being a 5-year term loan for most companies to 3 years or less. So let's talk about pricing a little bit, and we'll talk about leverage loan pricing. You really can't get a proxy for what leverage loan pricing is. That's bank loans to leveraged companies, companies that have more than a normal amount of leverage. And the primary benchmark we use is the flow index, which is really the price in the secondary market for the largest, most highly liquid institutional term loans of the 15 largest companies. So this would be companies like First Data, TXU, HCA, and Ford. And for those companies, they're typically single B plus credit ratings. The average spread over LIBOR underlying these loans is 225 basis points. So the real question is, what's the discount to purchase these loans? In other words, what price is a percentage of par or what people willing to pay? At the low point, that was 63.4%. It's come back to about 90.4%. It was pretty close to par in September of 2007. So when you translate that into a price, that means that if you bought the price at the low percentage of par, you were getting a yield of 1,241 basis points over LIBOR. And today that number's been cut to 518. So again, lots of improvement in terms of where things are, but these numbers tell us we're not back to par pricing that occurred in 2007. And it's a similar story for pricing in the high yield market. And in December, this is for bonds, not bank loans. In December, the high yield bond market traded in the secondary market. The average was around 21%, and that number's fallen to about 11%. Said another way, if you were a high yield trader and you were long bonds for that period, you're very rich, because that kind of change in price, in rate, has done wonders for the value of your inventory. Let's talk now about investment grade pricing. This is for the highest quality companies, and the average credit quality on this chart is somewhere around single A, and you can see that prices over Treasury spreads for these loans have started out about 81 basis points, gapped out at 280 basis points, and we've come back to 115. So again, great improvement, but nowhere near the 81 spread that was there in January of '08. And then lastly, there's some indicative pricing for investment grade credits, and this would be more in the bank market, and you could just see by the direction of the charts that the spreads have widened and improved somewhat since May, but still significantly higher. I think the point here is that there's actually been more improvement in the bond markets than there have been in the bank markets, and I think that's perhaps because of stress in the system and just general availability of financing because of the capacity issues we talked about just a minute ago. And the other thing that's going on is default rates are increasing. So for leverage loans, you can see that the default rates have not been this high since the last recession, and they're still on the rise. So most people believe that default rates for both high-yield bonds and leverage loans will gap out beyond where they were in the '01, '02 period on this chart. And then here's the last issue that I think most people have really not come to fully embrace, and that's the looming wall of maturities that begins in 2011 and is expected to peak in 2014. Said another way, there's a lot of debt that's going to have to be refinanced in the 11 to 14 period. And these maturities were loans that were put on the books in the 2005 to 2007 time frame. A lot of them were done with capital based in the collateralized loan obligation market, which has really gone away. And so there's not enough liquidity in the system to refinance all this debt, and it will become a challenge for a lot of leverage companies to address this issue over the next 3 years. So we're really spending a lot of time advising our leveraged clients to get ahead of this problem and begin the process of refinancing their debt sooner than later. And, you know, just when we start thinking we're really having some fun, for those of you guys that have been reading the paper lately, you know, many regional and local banks face very large exposures to commercial real estate loans. Just as this market really starts into a free fall, appraisal values have fallen about 25% this year, and transaction prices have fallen about 39%, or the price that people are willing to buy a building that's for sale. There's, according to a lot of experts, including construction loans, there's about $287 billion in losses that are expected through the commercial real estate down cycle. This chart shows how unprepared or how exposed many of the largest banks in the country are to real estate. And this is just one way to show it, but here we look at real estate exposure as a percentage of a bank's capital. So in other words, banks have loans in all kinds of categories. This is just, let's just isolate the real estate, commercial real estate loans they have, not the consumer loans, not the lines of credit to commercial company loans. Let's just focus on commercial real estate. And as you can see from the chart, 5 of the 15 have exposure that's greater than 200% of their capital, and only 4 of the 15 have exposure that's less than 100% of their capital. The point here is that one of the fundamental principles of banking, of investing, of asset management, and as all the professors in the room will tell you, is good portfolio management. You can make individual choices and selections on stocks, on loans, on bonds, on investments, on girlfriends, boyfriends, but the best way to manage exposure is to manage a portfolio. And portfolio theory outweighs, the importance of portfolio theory outweighs whatever you think you are when it comes to good picking. Portfolio theory means you spread your risk, you spread your correlations. If you make one shopping center loan, you think about how many more shopping center loans you want to make. You look at geographic correlations and exposures. And what this slide is really telling us is that the banks in the United States have not been paying attention to good portfolio management. Obviously, there are a few of us that are in a selection, but we feel very strongly that this is a problem of people's own making when they seek to concentrate too much of their loans in one particular category. So there's $400 billion in commercial real estate debt that's scheduled to mature each year over the next 10 years. Leverage and pricing levels won't return to peak levels for some time, and so we think there's probably going to be a need for $1 trillion in additional equity and or debt that has to be lost or refinanced to get these projects down to their current values. Current credit and equity markets really lack the capacity to absorb that demand, so we expect that prices will continue to fall and that we have like a 3 to 5 year cycle to recovery. Now, that's the bad news. The reason I tell you all of this stuff and try to get your attention with this drastic statement is to tell you that on the back of this, more money is going to be made in commercial real estate in the United States than almost anything you can imagine, because once these assets do get marked and once the price falls to its current level, then that's when the distressed debt funds will come in, the smart investors and hedge funds. We at JPMorgan are actually making our plans for investing in real estate. It may be 2 or 3 years from now, but there will come a time where you can buy into great properties in Los Angeles or San Francisco or New York or Dallas or Denver and ride those up through the recovery. But between now and then, we've got to get to that price discovery that makes a buyer interested in investing. In addition to challenges from within our companies, balance sheets, problem loans, earnings pressures, banks also face the greatest external challenge that they've had in recent times, and it's coming in the form of regulatory reform. Bank regulatory reform is the second most important topic in Washington behind health care reform. And so we believe that once health care reform reaches some point, then you will start seeing a lot of attention in Congress towards passing a lot of new legislation. And we're seeing lots of signs that we're moving towards an activist government and a lot of populism, because people are unhappy about, and they're demanding reform. They're mad about the bailouts and the excesses that financial institutions participated in, and they want to fix it. So the administration plan highlights, 5 areas of financial regulation that they plan to address, part of you may say, well, why should I care? And I guess there's 2 good answers I can give you. First is that the reform could lead to unintended consequences. It could be bad for consumers and bad for corporations. So while there's a lot of good intention behind fixing problems that have been created by lax regulation, there's also an unintended consequence. And I tried to think of 2 examples that you might be able to relate to. But let me just give you one, and that's consumer credit reform. In the consumer credit reform, the legislation is saying that you can't charge for different levels of risk. So I don't know if you guys have, you may have friends that you loan money to, and you've kind of learned from experience they're kind of slow to pay you back. You may have other friends that you loan money to and they pay you back on time. One way that the credit card industry has dealt with that is by pricing credit cards differently based on your credit performance and your rating for credit performance. Unfortunately, a lot of the legislation is going to prevent that from happening. So when that happens, I think an unintended consequence is going to be that people are just going to say, below this level of performance, we're not going to issue credit cards to those individuals. And without those credit cards, that's just another way that a consumer isn't going to have access to finance short-term credit needs. I don't think that's what the government wants to see happen, but I just use it as an example of an unintended consequence. I think I'm going to skip that one. Before I talk about our company organizationally, how we're organized, let me just take a minute and talk about JPMorgan and why I think those of us here today are proud to work for this company. I think we've been a leader on the banking landscape. I think we've been a leader in Washington, and we're a good civic partner in terms of our contributions. And I think we do, as individuals, I think a lot of us work for this company for a long time. We're proud. We carry it on our sleeves with great pride, and we know that our actions individually and collectively matter a lot, particularly at a time when people are so upset with our industry. We believe we've been at the forefront of sensible compensation practices. We pay our people well, but we pay them for performance over many years. And looking at performance, we try to properly account for the risk that they're taking. We've always had clawbacks and arrangements in our arrangements with our employees that when risks come back to bite us, there are consequences from a compensation standpoint. And it's never really been a simple financial measure. It's always included the broad contribution a person brings to the company, such as integrity and compliance, recruiting and training, diversity, outstanding workforce, and building a better business for the future. We've had a bonus recoupment policy in place since that's much more harsh than what even Sarbanes-Oxley required. We don't have change of control agreements. We don't pay big exit packages when people leave the firm. We don't have golden parachutes. We don't have special severance for our senior executives. And our health care and other benefits plans are written in such a way that our lowest paid and compensated employees have more coverage than those of us at higher paid levels. We've always had a significant percentage of our incentive comp in stock, so that we get stock in the company, approximately 50% of our senior management team. And then for folks like me on the operating committee, we're required to hold on to 75% of the stock that we receive as compensation as long as we work at the firm. So to say that we're all in, like Texas Hold'em would be probably the proper analogy for me to make. Hopefully I'm holding a pretty good hand. Compensation is a complex issue, but I think we deal with it responsibly. And we really try to hire and train really smart people, but we focus a lot of time on integrity. So really, before I close and try to answer your questions, let me spend a minute describing our organization. You know, we have two brands at Chase, JPMorgan Chase. The Chase brand in general is the one we use at the consumer level and for business banking and local middle market banking. Those are the clients that really go to the branch every day. They recognize the Chase brand, and they're more comfortable dealing with us with that name. And the JPMorgan name is our large corporate brand and our high net worth brand. The business I run, commercial banking, is one of our 6 business lines. As the Dean mentioned, we're a coast-to-coast bank now with the addition of WAMU. And what we really hope to do with WAMU, besides bombard the airwaves with our cute little ads and billboards, is to just become what I would call an interesting alternative to a substantially consolidated banking market in California. So instead of having the usual suspects to bank with, we want to hopefully bring to you our brand of banking to the West Coast. We're the lead bank in the New York market. We're the lead bank in many of the southern U.S. markets, including Texas, across the Midwest, including Chicago, and we've had large shares in Phoenix for years, Denver, and Utah. But this is really a great opportunity for us because at a time when banks are particularly weak, we've bought a great franchise with a great branch network, and we're looking forward to building a team out here to take advantage of it. You know, in closing, I would tell you that we're healthy and well capitalized. We're still lending and standing by our customers. We're a responsible and accountable player in promoting economic recovery. We continue to provide credit to our customers, and we're extending billions of dollars of loans to consumers, to credit card account lines, to new loans to mid-sized companies, loans to corporations, and loans to small business. The one thing we can't do is we can't stop the fact that we're in a recession and that there's a lot of risk out there in the marketplace. And the one thing we'll do above anything else is we'll protect our franchise against the unwise lending practices that always get companies in trouble every 7 or 8 years when we have a recession. More than anything else, we know the best thing we can do for our customers and for our shareholders and for our employees is to run the place like it's our money and to be certain that whatever we do individually or corporately doesn't put us in a position where we're distracted or weak at a time when our strength and stability is what our customers really want from us. So, Dean, with that ends my prepared remarks, such as they were, and with the time we have, I'm happy to answer any questions.
Well, I'm sure this is a logoed item that you'll want to display at the next meeting
Absolutely.
of UT.
Stand over here
McComb
so we can get
School.
the picture with
Yeah.
you.
Oh, thank you.
Right.
Thank you.
Thank you.
And I wanted to just note that, thank you, that there are microphones there, and I thought that as you line up, I'll ask the first question. And we have probably about 15 or so minutes for Q&A. So I'm going to shift it to the management side of things. And frankly, we spend a lot of time on leadership here at this school. And to use your analogy again, it seemed like Jamie Dimon, as the head of JPMorgan, really emerged as a very powerful and prudent leader who through this turmoil built rather than declined in the business. And I want to ask you, and he seemed to know when to hold them and when to fold them, which is using the analogy. So I want to ask you, what are the generalizable leadership ingredients that came through this time of enormous stress in what he and the management team did? What can we learn about leadership?
Okay. You know, I think the first thing I would say is that big companies are complicated, but it's no different than anything else. Every problem can be dissected and broken down to its simplest components. When you come to JPMorgan in New York and you walk out on the 5th floor, and you'll see just one of the largest floors you've ever seen, and just traders and quotrons and electronics, and there might be on it, and we've got several, 5 floors of that. So, and you look across that floor and you say, what's going on here? It's complicated, but really what I would tell you is that there's a bunch of individual traders, and those traders build up to a desk, and the desk is taking a position, and so there might be 27 desks on that floor. Every desk can have the MIS to be loaded into the system to understand what their trade positions are, what their daily moment positions are, what their overnight is, and then each one of those desks has supervision above it. At the close of business every night, those positions can be correlated so that, that if 3 people in the building are taking a long position on Australia, on their currency, for example, just to use that random example, those positions are going to come to light, and if we're uncomfortable with them, we can close them out during the day, the next day, and so I would say the first point I'm making is you break the problem down to its tiniest points. And whenever it looks like a big cloud, you're in trouble. And I would argue that when you look at our systems, and and Jamie's the architect of a lot of those systems, I've worked in banks where you didn't know what your position was. So my point is you've got to break things down, and you've got to be disciplined about really understanding exactly what's going on. And the bigger and more complicated it is, the more you need to understand that. The second point, which is really related to the first, is you've got to offer a complete transparency. So to me, it's transparency, number one, and number two, it's the ability to break problems down into their easiest points. And then the third thing I'd say, which is particularly true of Jamie, is he has this unbelievable curiosity and intensity and a willingness to keep pressing forward and keep trying to improve himself individually, never resting, even though he's the CEO and could clearly take a couple of victory laps at this point. He could read the paper, believe what people are saying about him, and serve to be self-congratulatory. But what I see in the man is a desire to be the best. That means that tomorrow and the next day and the next day, he's going to continue to hone his skills, and that's his plan until he passes the position on to the next person.
And I'm waiting for questions here, but I surmised from that answer that it was about, in the complexity of your organization, how many employees?
180,000.
180,000. How do you get them all operating with the same values? And you talked about how you transmitted down the line those key values through operations, but also through the message.
Right, and it's incredible persistence. It's a great question because it requires someone who's not afraid to address conflicts, someone who's not afraid to say to someone, you're a great producer, you make a lot of money for this firm, but you're not compatible with our our strategy. It starts at the top, and every layer has to be signed up for it. And occasionally the examples are made. Someone leaves, those around them know it was the jerk factor. In other words, they were not easy to deal with. They were smart, they were capable, but they weren't collaborative. They didn't believe in the true sense of partnership and sacrifice. So that's okay. They're not compatible with this organization, let them go work somewhere else.
And the jerk factor is very, very difficult to exercise when you have a top performer.
That's right.
Yeah. So when you ask a question, just tell who you are.
Hi, thanks for coming.
Thank you.
I'm Tyler Peterson, first year in the MBA program. I was wondering if you could elaborate on the acquisition of Washington Mutual. I imagine that it happened under some considerable time constraints, and so what were some of the considerations that you at the management level had to look at and deal with, and then sort of, make the decision in the moment under probably a lot of stress?
No, it's a great question, and it was, and I'll be very specific about that because but we had one advantage, and that was 9 months or so before they failed. They were forced by the FDIC and their board to go out and look for strategic alternatives to raise capital. And they had two choices at that point. They had a choice of selling to someone like us, and they knew we were dying to buy the place. But in so doing, there'd be a change of management control. And it's a terrible thing to say, but that weighs on people sometimes. Like, okay, I'm going to sell my company and do what's best for my shareholders, but all of the management's going to be out of work because there's going to be, we're not going to need all of that, the CEO and all that management team. The other choice was to go find an equity partner that would leave the management team in place and allow them to raise more capital, which is what they did. TPG and some other big equity firms put the money up. 6 months later, the losses became far greater than what the management or the equity sponsors had thought was possible, and the bank was going towards failure. So we geared up a team. The first time we looked at it, I spent about 2.5 weeks with a team looking at every loan in their book related to their wholesale business, while we had literally 20 or 30 people looking at their resi book and all of their market exposures, their deposit book, their branches, everything. And so when we made the first bid, we had a lot of filed information and a lot of due diligence that we'd already done. So when we came back the second time, 2 weeks before the FDIC planned to fail the bank, they asked for bidders to come in. The bank management didn't even know this was going on, so it was very quietly done with the bidders looking. And we submitted bids on a Wednesday. On Thursday, we were told we had won. In order to do it and feel comfortable about it, we wanted to raise equity. So when we found out on Thursday morning that we were going to raise equity, we did an overnight $5 billion equity offering, which had never been done on a Thursday because you normally don't price on Friday mornings. So, so the management team had to be on the phones to help sell the equity and get the investors ready. All the investors were under a non-disclosure agreement and couldn't talk about the transaction. The deal got announced on Friday, so if you worked at Washington Mutual, you woke up Friday morning, it says, bank fails, JPMorgan Chase wins, and then you pick up the phone at your office and check your voicemail, and you had a message from Jamie saying, welcome. And you went to the office, that day, and I'm standing in Orange County with all the management team was sent to different locations. So when people were walking in, we were there, and they were kind of like, how did, it was really surreal. So, but we knew that the more we could stabilize the organization and the management and the people in the field, the better the value was going to be held. There had been a run on the bank, and that's why the FDIC had to step in at the end, because they were losing billions of deposits by the day, and we wanted to stop that, and the FDIC did. We paid a price for the bank that actually put money into the FDIC. We were able to do so because we wiped out the bonds and all the equity players, which is what happens in a free market society. And we took over the bank, and it's been a great investment for us. And I think if you ask somebody from Washington Mutual what it's like, I think they're getting used to new systems and processes. But I think they'll always say, thank heavens we were bought by an organization that's wanted to preserve and grow this franchise, and we've got jobs as a result of it.
Thank you.
Mm-hmm. Yeah.
Hi, Joe Backash, also a first-year MBA student.
Okay.
Wondering if you can comment on the securitization markets and what way, shape, or form those may or may not come back?
It will come back. It always does. And it will come back smarter and wiser with a better understanding of the risks that we didn't understand the last time. So securitizing liar loans, stated income loans, where you tell me what you make and I'll put it in a pool and sell it to somebody, and I'll slice it and dice it and we'll get a rating agency to rate it. I don't think that's going to happen again. But that, by the same token, it doesn't mean that you can't take a bunch of individual loans, and just by that conversation we were having a minute ago about portfolio theory, you can create a diversified set of individual loans and create a better quality security as a result of that. You can create tranches of risk and you can securitize it. But it's sort of like, asking somebody out for a date after somebody's dumped you. It takes a little while to get over the pain and the suffering and the sorrow and the sadness. You don't look like that's ever happened to you, so I think there's a certain amount of, you got to get over what happened. You got to understand what happened, why it happened, and how do I make sure it doesn't happen again. But the notion that securitization wouldn't come back in some form and become a significant and important part of the capital markets, I think, would be to underestimate, financial engineering and ingenuity.
Thank you.
Hi, my name is Dave Curtin. I'm a third-year fully employed MBA student. You
great.
talked a lot about the amount of capital constraint. There's hundreds of billions of dollars in loans that are coming due, commercial loans over the next few years. And, I'm assuming that you guys underwrite a decent portion of that. And besides referring your clients to the investment banking side of the business so that they can do bond offerings, what's your plan to take advantage of the constraints in the capital market, and how are you guys going to handle that?
It's a wonderful time for us to be leaders, right? So sometimes the best way to be a leader is to just tell people to start focusing on it now and to look at alternatives. The good news is the equity markets have opened up for good companies, and the debt markets have opened up for good companies, and so a lot of that debt will get refinanced in due course. We are also a healthy bank with lots of capital, so we're in a position to make every good loan we possibly can. When we run into a company where we see the capital structure and we say you have more debt than is prudent, they're having losses or they're going to risk defaulting on the renewal, then in those situations you have to go more into a kind of a workout mode where you just try to figure out what's the best alternative. Unfortunately, I think that's going to probably mean that a lot of debts will not be fully paid, and banks and other lenders will be forced in the restructuring to take some discount. So at the end of the day, it all gets worked out, but I don't see, and again, I don't have a crystal ball, but personally, I don't see how it's going to get worked out this time without a lot of losses through the discounting of the debt, which is in excess of what the companies can pay or what the projects can pay. And that process will be very painful for banks and financial institutions that find themselves in that position. But as I said, a lot of that is in leverage finance and in real estate. And fortunately for us, those are just not large, overwhelming categories because we had a very disciplined portfolio management process.
Last question.
My name is Stan Krastev. I'm a first-year FEMBA and also work for one of the top 3 mortgage companies.
Okay.
I'm also a big fan of the JPMorgan business model, and I'd like to welcome you guys to the West Coast.
Oh, thank you.
I was just wondering, obviously you guys come here with a lot of cash to invest. What is your plan of action to gain market share here on the West Coast? You want to do it through origination on commercial and consumer real estate? Origination, buyout, acquisitions.
Yeah, I'll tell you, for us, it's about client selection. It's the same way we run our business. We try to pick really good people, smart, capable people that have our values and are compatible with our company, that are willing to work really, really hard and commit to an organization. We do the same thing with clients. We try to select the clients. We try to pick people that we think will make great customers for a long period of time. If somebody comes in one of our branches and insults the teller 3 days in a row, we fire them. We close their account and ask them not to come back. So, in other words, we think that it's important to have standards for yourselves and for your customers. So, honestly, for us, it's not about a particular product strategy, but it's like we start by looking at a market like Los Angeles and figure out how many companies are here. And then we do a lot of research. We have tons of analysts that analyze these companies and look at them, and then we decide which ones we like because we like the way they conduct their business, we like their track record, we like their history. The same with individuals. And then we try to seek to show those individual solutions to their financial needs, whether it's a better way to mortgage their home or to have a credit card that fits their needs. And we're constantly trying to develop products and services that fit the mainstream of what our customers and individuals want. Now, that all sounds fine and good. That's our intention. We're stumbling and fumbling around like most people, just trying to get the right course of action. But more often than not, by staying focused on what are the needs that you have and what are the ways that we can serve your needs, as opposed to trying to sell you a product or just show you what we think makes sense. The more we can be consultative and take that approach with clients and individuals, we think that makes us different. We also have expertise in areas that others don't. We're really big in international, and that's an important, as you know, from living out here, that's a huge, important thing for companies and individuals is an ability to transact business internationally, and we have a great network, and that differentiates us. That's one example of how we're differentiated from other banks out here. We have other expertise, asset management, investment banking, that's better than a lot of the competitors out here. So hopefully as people get to know us, they start thinking, not only do these guys feel and look a little different, but they're actually better in certain areas where I need particular help and focus, and that's pretty much how we try to do it.
Well, thank you. I'm sorry I'm going to cut off the questions now because
we got class, everybody.
Is cool.
Time to go to class.
And I want to thank Todd. I think that the growth of JPMorgan Chase here in the West Coast bodes very well for UCLA Anderson. And I think it bodes well for JPMorgan because I believe in my heart and through the evidence that I see that we have the greatest people that will populate JPMorgan with the right values that you seek. So thank you very, very much. Thank you for being here. Thank you for the